Deep in the money call options. These are a type of options contract that has what we call intrinsic value, and that means it's greater than its strike price. So this means that the underlying asset is trading at a higher price than the strike price, and the options buyer would make a profit if they were to exercise their option. So for example, if you have a call with a strike of $90 and Apple stock rises to $110 before the expiration date, then your deep in the money call option would be worth $20. That's the difference between what you paid for it and the current value. Now, you could decide to exercise your right to buy 100 shares of Apple stock at a price of $90 each, or like most people do, just sell the option on the open market for more than you initially paid. That's just the general way that traders trade options. So when deciding whether or not you're going to buy deep in the money calls, there's a few factors that you got to consider. You got to consider time frame, the cost of entry, potential ROI, the return on investment, your risk tolerance level, the volatility of the underlying asset prices, and other market conditions like liquidity levels, open interest. A time frame, that's got to be taken into account since option contracts, they have an expiration date, and that's associated with them, so you should think about how long you plan on holding that position. Also, the cost of the trade has to be factored in since this can significantly affect your ROI, your return on investment, depending on how much you initially spent, and that is the premium that you paid when you purchased these options. So deep in the money calls, they're a great way to leverage your capital and potentially increase returns, but it's important to understand when they should be used and how they're going to benefit you. So when it comes to buying them, timing's key because again, they can be pretty profitable if they are used correctly and at the right time. So one of the better times to buy deep in the money calls is when you expect market conditions or news events to cause an increase in the price for your underlying asset. So for example, if you anticipate that a company's stock is going to go up due to positive earnings reports or other favorable news, well, buying deep in the money calls could be a good way to capitalize on that. So you got to have an idea of how long you're going to hold and when the expected price move may be. When you buy options, you pay a premium, and the premiums for deep in the money options are more expensive than at the money or out of the money options. So these contracts, they can generate larger returns than OTMs and ATMs due to their greater intrinsic value relative to the cost of the option. Remember, they're expensive and the expected return should mitigate those costs. So again, it's important to remember that even though they have great potential profits, they come with risks because time decay can eat away at the value of that contract, and sudden moves against you can be pretty costly. But at the end of the day, the maximum loss is the cost of the trade. But that can be pretty high. So why would someone sell deep in the money calls? Well, there's a few reasons. One reason that they believe that the underlying asset's not going to increase over time. So if this is true, then selling deep in the money options for them can generate income. They're not taking on a whole lot of risk because they don't think that the asset's going to move a whole lot, so that their contract is probably not going to get exercised. Another reason, a hedging strategy. So if they own shares of stock and they want to protect against losses due to market volatility or some other factor, they may choose to sell deep in the money calls on those stocks as insurance against any potential loss from holding them long term. So this way, even if the stock goes down in value, they can still make money from selling these options. And that offsets some or all of the losses from owning the shares directly. So here's an example. So let's say stock of Apple is trading for $153 per share, and you purchase a call option with a strike price of $145. You have intrinsic value of $8. That's just the difference between the stock and the strike. So if Apple stock increases to $160 per share, then your intrinsic value is going to increase to $15. And then you can exercise your option. You could buy Apple shares at only $145 instead of paying full market value. I want you to notice that as we get closer to the current price of the stock, the premiums get cheaper. With a $145 strike, it would cost you about $11 a share. So again, remember, with a contract for options, you have the right to buy 100 shares of whatever the underlying is. So if you were buying this contract here for $11, it would cost you $1,100 for the deep in the money call. Now, in the money versus out of the money calls. That's the main two types you want to think about. Now, the out of the money calls have a strike price that is higher than the current market price. In the money calls, that strike price is lower than the current market price. This is for calls, okay? So the biggest difference is really the premium paid. So in the money calls are probably going to be more expensive because they have value. So if you exercise them, you'd make money right away. On the flip side, out of the money calls are cheaper because they don't have any intrinsic value yet. So exercising them would not result in an immediate profit. Another key difference is the potential for return on investment. So since in the money calls already have some value when they're purchased, they can generate greater returns compared to out of the money ones, as long as your prediction about future stock movements is correct. However, this also means that if your trade turns out wrong, or those markets just move against you unexpectedly, you could end up losing more money with an in-the-money option than with an out-of-the-money because it cost you more to put it on. So out-of-the-money calls, they offer you the advantage of unlimited upside potential without requiring a large upfront cost. So this makes them ideal for those who want to gain exposure to stocks, but they don't want to commit too much capital at once or take on a whole lot of risk before seeing how things develop in real time. So when you're trying to decide what type of call option best suits your needs, you got to consider factors like how much capital you have available, what kind of expectations for return on investment are you expecting, whether or not short-term or long-term gains is your goal. Wrapping it up, deep in the money calls, great way to gain exposure to stocks. You don't have to buy the stock outright. So this offers you the potential for larger returns with limited risk as part of an overall strategy. When you're considering buying deep in the money calls, it's important to have an idea when you expect to move in the underlying stock, okay? We don't want time decay to add up and rip apart our contract. So if you do buy deep in the money calls, understand they're expensive, but that's also going to combat a little bit of that time decay. So you can afford some time before that stock gets moving, but you still need that move to happen relatively quickly. The closer you get to expiration, the greater the increase in the delta of an option and the acceleration of decay if that stock's not moving. So we need to see a move. We actually have an 8-minute options trading cookbook. It's totally free. It's got some powerful strategies. It's going to help you generate some income. It's 5 different paths to success on every options trade. The link is in the description below, or it's off here to the left. It's one of our most popular options giveaway. Hope you download it. Thanks for watching.